Have you ever wondered why financial news often fixates on interest rate decisions? Many people assume interest rates only matter if you're taking out a loan, buying a home, or financing a car. If you're not carrying debt, it's easy to believe these economic levers don't really affect you. However, this perspective overlooks a fundamental truth. Interest rates influence far more than just borrowing costs. They quietly shape decisions made by households, businesses, and governments across the globe. These decisions, in turn, affect everyone, regardless of their personal debt status. Even if you never borrow a dollar, interest rates play a profound role in your financial environment. Understanding this intricate relationship is crucial for financial literacy, sound economic education, and informed decision-making. This video is designed to illuminate why interest rates are a universal economic force. By the end of this discussion, you will understand what interest rates actually represent in the broader economy. You will grasp how they influence behavior throughout various sectors, from individual consumers to multinational corporations. Furthermore, you will see why changes in these rates often lead to significant economic shifts that impact nearly everyone. This exploration is not about predicting future interest rate movements or offering specific financial advice. Instead, it aims to provide a foundational understanding of how interest rates function. Our goal is to make economic changes feel clearer and less confusing, empowering you to interpret financial news with greater insight. At their core, interest rates are the price of money, specifically the price of using someone else's money for a period. They represent the cost of borrowing and the return on lending, acting as a fundamental mechanism in any market economy. Think of it as the rent paid for capital. More profoundly, interest rates embody the price of time. They reflect the opportunity cost of having money now versus having it in the future. This concept is vital for understanding investment decisions and consumption patterns. When you lend money, you forego the immediate use of that capital. The interest rate compensates you for this delay and for the risk that the money might not be repaid. For borrowers, it's the cost of gaining immediate purchasing power or investment capital. This fundamental pricing mechanism influences the allocation of capital throughout the entire economic system. It determines which projects are viable, which savings vehicles are attractive, and how much consumers are willing to spend versus save. Understanding this basic principle is the first step toward true financial literacy. For students, grasping this concept clarifies the mechanics of loans, bonds, and investments. For business owners, it directly impacts the cost of expansion. Investors use it to discount future cash flows, while policymakers adjust it to steer the economy. Beyond being a mere cost, interest rates function as a powerful system-wide signal. They communicate vital information about the health of the economy, the availability of capital, and the prevailing risk appetite. This signaling role is critical for all economic actors. These rates signal how easy or difficult it is to access capital, influencing everything from small business loans to large corporate mergers. They also reflect the market's perception of risk, with higher rates often indicating greater perceived risk in the economy. This makes them a crucial indicator for investors. Furthermore, interest rates signal how future value is being priced today. A lower rate suggests that future earnings are highly valued, encouraging long-term investments. Conversely, higher rates discount future earnings more heavily, favoring shorter-term returns. This directly impacts asset valuations. Central banks, like the Federal Reserve, use interest rates as a primary tool for monetary policy. By adjusting benchmark rates, they send clear signals to the market, aiming to stimulate or cool down economic activity. This policy understanding is essential for policymakers and anyone tracking economic trends. For business planning, these signals are invaluable. They inform decisions about inventory levels, capital expenditures, and hiring. A clear signal of rising rates might prompt a business to accelerate planned investments before borrowing costs increase further. Even households with no personal debt are significantly affected by interest rate movements. These rates cast a wide net, influencing various aspects of daily financial life, often in subtle but profound ways. Their impact extends far beyond the monthly loan payment. One of the most direct impacts is on housing affordability. When interest rates rise, mortgage payments increase, making homes less affordable for potential buyers. This can cool down the housing market, affecting property values and construction activity. Even renters feel the pinch, as landlords' borrowing costs can influence rental prices. Savings returns are also directly tied to interest rates. For savers, higher rates mean better returns on bank deposits, certificates of deposit, CDs, and money market accounts. Conversely, low rates can erode purchasing power over time, pushing individuals to seek riskier investments to achieve their financial goals. This is a key consideration for retirement planning. Job stability and employment opportunities are indirectly influenced. When interest rates rise, businesses face higher borrowing costs, which can lead to reduced expansion plans, hiring freezes, or even layoffs. This ripple effect can impact the broader labor market, affecting everyone's job prospects. For students, this means the cost of student loans can fluctuate, impacting their future financial burden. For the general public, it affects the cost of living, from housing to the prices of goods and services, as businesses pass on their increased costs. Understanding these connections is vital for personal financial planning. Businesses, from small startups to multinational corporations, are profoundly sensitive to interest rate changes. These rates are not just an accounting entry. They are a critical factor in strategic planning, investment decisions, and overall operational viability. They shape the very landscape of commerce. Interest rates directly influence a business's expansion plans. When borrowing costs are low, companies are more likely to take on debt to fund new projects, research and development, or market expansion. Higher rates, however, make such ventures more expensive, requiring a higher expected return to justify the investment. This directly impacts business growth. Hiring decisions are also closely linked. If a business anticipates higher borrowing costs and a potential slowdown in consumer spending due to rising rates, it might delay hiring new staff or even consider workforce reductions. Conversely, lower rates can foster an environment of growth and job creation. Inventory management is another area of impact. Businesses often borrow to finance their inventory. Higher interest rates increase the cost of holding inventory, encouraging companies to adopt just-in-time inventory strategies to minimize carrying costs. This can affect supply chain resilience and efficiency. Long-term investment, such as building new factories or upgrading technology, is particularly sensitive. These projects often require significant capital and have long payback periods. Higher interest rates increase the hurdle rate for these investments, meaning only the most profitable projects will proceed. This shapes the future productive capacity of the economy. For business owners, understanding these dynamics is crucial for effective business planning and risk management. For investors, it provides insight into corporate profitability and future growth prospects. Policymakers consider these business responses when setting monetary policy. Governments, like businesses, are major borrowers, and their fiscal health is intricately linked to interest rate movements. These rates significantly impact national budgets, debt servicing costs, and the flexibility governments have in making policy choices. This is a critical area for policy understanding. A primary concern for governments is the cost of servicing their national debt. When interest rates rise, the cost of borrowing for new debt issuance increases, and existing variable rate debt becomes more expensive. This means a larger portion of tax revenue must be allocated to interest payments, leaving less for public services like education, healthcare, or infrastructure. This directly affects budget flexibility. Higher debt servicing costs can constrain a government's ability to fund new initiatives or respond to economic crises. It can lead to difficult trade-offs, potentially requiring tax increases or spending cuts, which have broad societal implications. Interest rates also influence a government's policy choices. During periods of low interest rates, governments might be more inclined to undertake large infrastructure projects or increase social spending, as the cost of financing is relatively cheap. Conversely, high rates can force fiscal austerity. For policymakers, managing the national debt and understanding the impact of interest rates on the budget is paramount. For the general public and students, it highlights how macroeconomic factors directly influence public services and taxation. Investors also scrutinize government debt levels and interest rate sensitivity when evaluating sovereign bonds. Interest rates play a pivotal role in determining the present value of future income streams, which in turn dictates asset prices across various markets. This discounting mechanism is fundamental to how financial markets operate and why they react so strongly to rate changes. It's a core concept for investors. When interest rates are low, future earnings are discounted at a lower rate, making them appear more valuable in today's terms. This tends to push asset prices higher, as investors are willing to pay more for future cash flows. This effect is seen across different asset classes. Conversely, when interest rates increase, future cash flows are discounted more heavily. This reduces their present value, often leading to a downward adjustment in asset prices. Investors demand a higher return to compensate for the increased cost of capital and the opportunity cost of alternative investments. This relationship is evident in the stock market. Higher interest rates can increase a company's borrowing costs, reduce its profitability, and make future earnings less attractive. This can lead to lower stock valuations, especially for growth companies that rely heavily on future earnings potential. In the real estate market, higher interest rates translate to higher mortgage costs, reducing buyer affordability and demand. This can lead to slower price appreciation or even declines in property values. For investors, the cost of financing property directly impacts their return on investment. Bonds are perhaps the most directly affected. When new bonds are issued at higher interest rates, existing bonds with lower rates become less attractive, causing their market value to fall. This inverse relationship between bond prices and interest rates is a cornerstone of fixed income investing. Understanding this mechanism is crucial for any investor. Interest rate changes do not produce immediate, instantaneous effects throughout the economy. Instead, they propagate through the system with a significant time lag, often taking months or even quarters to fully manifest. This delay is a critical factor in economic analysis and policy implementation. Households typically adjust their spending and saving behaviors gradually. A rise in interest rates might not immediately deter a planned home purchase if the buyer has already secured a pre-approval. However, as rates persist or rise further, new buyers will face higher costs, leading to delayed decisions. Businesses also adapt over time. Investment projects are often planned months or years in advance, and existing contracts or financing arrangements might shield them from immediate rate changes. However, as new financing is sought or existing debt matures, the higher costs will influence future investment and hiring. Employment, often considered a lagging indicator, responds even later. Businesses typically try to absorb increased costs or reduce demand before resorting to layoffs. Conversely, job creation might only pick up significantly after sustained periods of lower rates and economic expansion. This inherent delay often creates confusion and can make it challenging to assess the immediate impact of monetary policy. Rates may change today, but the full economic effects might only become apparent many months down the line. Understanding this time lag helps reduce frustration and provides a more realistic perspective on economic cycles. For policymakers, it means decisions must be forward-looking, anticipating future conditions. Interest rates are not just numbers. They are powerful shapers of economic expectations. When these rates change, they force a reevaluation of assumptions that were formed during earlier, often more stable, periods. This adjustment process can feel profoundly disruptive, even if it's a normal part of economic cycles. Plans built around cheap financing, such as aggressive business expansion or large personal purchases, suddenly become more expensive or less viable. The cost-benefit analysis shifts, requiring individuals and businesses to reconsider their strategies and priorities. This can lead to a sense of uncertainty. Expectations of stable growth, which might have been fueled by prolonged periods of low rates, can be challenged. Higher rates can signal a central bank's intent to slow down an overheating economy, leading to revised forecasts for corporate earnings, consumer spending, and overall economic expansion. Predictable costs, whether for mortgages, business loans, or government debt, become less certain. This unpredictability can make long-term planning more difficult and can lead to a more cautious approach from all economic actors. The shift from certainty to uncertainty is a major source of discomfort. This adjustment process feels uncomfortable not because it is abnormal, but because it forces a recalibration of deeply ingrained assumptions. It's a period of transition where the economic landscape is being reshaped. For investors, this means reevaluating portfolio allocations. For business owners, it means revising strategic plans. And for the general public, it means adjusting personal financial goals. Instead of asking, are interest rates too high or too low, which often leads to emotional reactions, a more helpful and analytical question is, what behavior do these rates encourage? This reframing allows for a more objective understanding of their role. Interest rates are not moral judgments. They are economic signals. They communicate the prevailing conditions of capital availability, risk, and time preference within the economy. Understanding the message these signals convey is far more useful than reacting emotionally to their level. When rates are low, the signal encourages borrowing, spending, and investment, stimulating economic activity. When rates are high, the signal encourages saving, caution, and a more selective approach to investment, aiming to cool down inflation or stabilize an overheated market. By interpreting these signals, individuals can make more informed personal financial decisions, such as whether to save more or invest. Business owners can better plan their capital expenditures and hiring strategies. Investors can adjust their portfolios to align with the prevailing economic incentives. For policymakers, understanding the behavioral response to interest rate signals is crucial for effective monetary policy. It allows them to anticipate how their decisions will ripple through the economy and influence the actions of millions. This analytical approach fosters greater financial literacy and economic understanding for everyone. You now understand that interest rates are far more than just the cost of borrowing. They represent the fundamental price of time and capital, influencing behavior across the entire economy. These rates affect households, businesses, governments, and financial markets in profound ways, even when you are not personally borrowing money. With this deeper understanding, changes in interest rates become easier to interpret and less emotionally reactive. You can now see how they act as powerful signals, guiding economic decisions and shaping the financial landscape for everyone. This knowledge empowers you to make more informed choices in your personal finances, business planning, and civic engagement.